In this video, we're going to talk about the hedge fund trading strategy of a short-only fund. Stay tuned. Hey traders, a very warm welcome to you. Okay, so hedge funds will pick a specific strategy they want to employ. Let's talk about the short-only strategy. This applies to shorting equities. Okay, so the theory is that these companies are going, or these hedge funds are going to go out and say, you know what, that is overvalued. That story is nonsense. There's a flaw in the accounting. They're going to pour through, multiple things that they believe are adding to this overvalued stock. And they're going to go out there and going to borrow the shares, short the shares, and hope that all this comes to light and they're going to make a lot of money. Now, of course, big shorts that we all know about, obviously if you've seen the film The Big Short, things like the housing crisis, the banking crisis, those are big hefty ones. And this is the law of a short only fund, is that if you get on the end of a really good short, you make a lot of money very, very quickly. You can make multiple yearly returns from standard kind of long only funds in a very short period of time. And that's the reason a lot of people get into it. They can highlight, if they highlight accounting fraud, if they highlight maybe some sort of practices that are eventually going to be banned by governments, or if they're just generally trading something that they believe is overhyped. I mean, there's obviously different strategies there that they can pick the shorts, whether it's fundamental, whether it's a fundamental shift in the way that governments work, or whether it's a company that's committing fraud or whatever on an extreme basis, or just something that's unsustainable like a bubble. Then they're going to make a short, try and benefit from the potential downside in that. However, as you know, if you've gone short, and as I know if you've gone short, and as you see every day in the charts, you can be wrong many multiples of your even maximum profit. We've seen charts go from $10 a share to $100 a share before they eventually come back down to $2 a share. So if you're short selling, your timing has got to be spot on. And that's why we have such a turnover of short funds. Guys start up with a short fund, maybe they make a bit of money, then they get a bit stubborn, they hold something, and it doesn't take much for them to get wiped out completely. And the problem you've got as well with being a short only fund is that you are susceptible to being called in on your shorts. If you haven't sort of checked out a video, I've done another video and talked about short selling, exactly the same thing. You're borrowing those shares and shorting them. If the shares are being squeezed, and all of a sudden you think about many years ago, there's a great example of this with Volkswagen and Porsche. Go and check it out, Google it and find out all the information on that. But basically, short sellers got absolutely hammered because a lot of people were selling shares they didn't own, and then all the shares were recalled, and there was a huge short squeeze because everyone was trying to get out of the same door thinking, man, this is going to kill our company. So potentially you've got good returns, and that's the law of it. There's the kind of law into it. The issue you've got is liquidity. It's very difficult to trade, in massive size when you're trying to pick specific companies. Now, of course, if you've got very big companies and you believe they're overvalued, example could be Tesla. It's a very popular one for short sellers. There's a lot of liquidity there and there's plenty of room, but there's only a few stocks that have that. And a lot of the biggest short opportunities occur in the kind of smaller stocks where, they're not maybe as on the radar as others. There's this potential for, the management to be doing something they shouldn't be doing. There's potential for, the impact not to be as obvious as or a negative impact, should I say, not to be as obvious to the market. And of course, the liquidity in those is much lower. So it's very difficult for these guys to leverage right up, and then it becomes difficult to add to the position as it goes their way, because it's very difficult to borrow the shares short. There's also a holding charge as well. Some of the very, very heavily shorted stuff, there's a big charge to hold it. So you've got to be right quickly to make it worthwhile. And also exiting the short. As I mentioned earlier, the risk is unlimited on a short. If you're stuck in a big position that takes you several days to unwind, and you would be if you were a hedge fund, you and I wouldn't. We can click of a mouse, we can get out of our few thousand shares or whatever it is we're trading. But a hedge fund will be in many days of kind of execution unless they're going to move the market with it. And so if they're on the bad end of a run, it's going to take them a lot to get out of position. All they're going to do is exaggerate the kind of move. Obviously, that happens a little bit as well on the flip side. If you're long, you're trying to get out of something that's hammering to the downside. But it's a little bit different on the short side. You tend to be a little bit trapped. We talked about the uncapped loss. That is what wipes out a lot of short only funds, because it only takes one to kind of go many multiples for whatever reason, and they're in too much size, they can't get out of the position, they're stuck in it, they're forced out of it. It just, you can see how that can turn into a real catastrophe for them. So we've got guys like Bill Ackman, of course, who famously has been interested in shorting Herbalife, and he has spent millions and millions investigating the company's practices, investigating how they do business, and he believes that it's illegal, he believes it's a pyramid scheme, he believes it's all going to crumble. And of course, at the time of the shooting the video, he's wrong at the moment, because the price is still going higher, and I don't know if he's still short or not, but he publicly came out and he said he was short. And he spends a lot of money investigating it. But that is the trouble as well. It's the same with any trading though, guys, isn't it, right? His opinion is worthless unless everyone else agrees with him and the price of that stock that he's shorting goes lower. And his hope, same with every short seller's hope, is that it dawns on the masses that this is an overvalued stock and it should be valued at $5 as opposed to $50. And that's really all you're doing as a short seller. You're saying, hey, I'm cleverer than the rest of the crowd, because at the moment, when price is agreed, that's price. That's what everyone agrees on. That's correct. But for you to go short and say, well, you know what, I think everyone's wrong here, and eventually it will dawn on them, that's ultimately what you're saying. A bit different, of course, from longs, where you just believe maybe a company is going to grow and the valuation of the company is going to grow just by the natural growth of the company and the improvement, the management skill and all that. Whereas shorting is a little bit like, well, okay, you could say, I think the company is going to decline and the earnings per share are going to go lower, which is fine. But generally, you're looking for those big, beefy returns where something is going to be a catalyst that just causes the company to just really have to restructure and make a lot less money, and you're going to make a lot of money very, very quickly. So that's the short only kind of stuff. Obviously, this is a very specific part of the hedge fund world, and the good thing about obviously being a short only fund is that you can go out there and you can say, hey, listen, I'm a short only fund, which means that if you've got money allocated to your mutual funds, your long only, your global macro, all this kind of stuff, we are completely uncorrelated. Our returns are completely uncorrelated with that, because we're looking specifically for these anomalies, these companies that we believe are very overvalued and we're going to make some money on the short side. So it's a good way for people to high net worth to diversify into these high risk. I mean, this is ultra high risk, guys. The chance of you losing all your money in a short only fund are quite high. I would suspect that the numbers on it, but just by the knowledge of the risks of it, it was going to be quite high. But the chance of you kind of making a lot on your money are also quite high. As with all trading, guys, the risk goes up, the reward goes up. If you want to play that game, you want to diversify, then people are putting some money into these short only hedge funds. Anyway, guys, that's short only. If you've got anything to add to the video, please do so in the comments section below. Otherwise, we'll see you in the next video. Take care, keep the risk managed,